Silver crosses $100 an ounce. In a normal market, that should be the signal flare. Capital rushes in. Management teams approve expansions. New supply appears. Prices cool. That is the story people tell themselves about commodities. It is neat, rational, and completely wrong for silver, because silver is not really mined on silver's schedule. Roughly 70% of global silver supply comes out of the ground as a byproduct of mining for copper, zinc, and lead. That means the decisive question is not, how high is silver? The decisive question is, are base metal miners expanding profitable tonnage? If the answer is no, then silver can rise violently without triggering the supply response investors assume is automatic. That is the fracture at the center of this market. A copper miner does not wake up one morning, see silver screaming higher, and decide to dig twice as much rock for silver's sake. He digs when copper economics justify it. If copper grades are falling, energy costs are rising, financing is tighter, or permitting is delayed, then silver production can stagnate or even decline precisely when the silver price is sending its loudest distress signal. So the official story says high prices cure shortages. The forensic reality is harsher. In silver, high prices can simply expose a shortage that was already there. And once that shortage collides with buyers who cannot postpone consumption, solar manufacturers, electronics producers, grid equipment makers, and the next wave of AI infrastructure, the market stops behaving like a speculative story and starts behaving like a rationing system. That is what this video is about. Not whether silver is bullish, not whether sentiment is turning, but whether the structure of this market has already made the traditional supply response mathematically obsolete. To understand why silver can remain scarce even at prices that look absurd, you have to leave the silver chart behind and go down into the cost structure of base metal mining. This is where most commentary fails. People imagine silver supply as if it were controlled by a global army of silver executives waiting to react to silver's price. In reality, much of the world's silver is tethered to mines whose real business is something else. A lead-zinc operation may recover silver from the same ore body. A copper mine may produce silver in concentrates almost as a bonus. On paper, that sounds comforting. More mines, more silver, more resilience. In practice, it means silver is trapped inside another industry's logic, and that logic can turn against silver very quickly. If copper demand weakens, copper expansions slow. If zinc margins compress, marginal tonnage gets cut. If lead projects face environmental opposition, output is delayed. In every one of those cases, silver suffers collateral damage even if silver itself is screaming for more supply. That is the first trap. The second is grade decline. A mining company does not just care about metal prices. It cares about ore quality, strip ratios, energy inputs, labor, water access, transport, financing costs, smelter terms, and political risk. When grades decline, the miner must move more rock to recover the same amount of payable metal. That raises costs and often reduces flexibility. If management responds by optimizing for the main revenue stream, copper, zinc, or lead-silver output becomes even more incidental. It is there, but it is not in command, so silver investors may be watching silver, while the mine that produces their future ounces is actually making decisions based on diesel prices in Peru, power reliability in Mexico, royalty changes in Chile, or concentrate treatment charges in Asia. This is not a normal supply chain. It is captive supply, and capital supply is notoriously inelastic. Not because nobody wants more of it, but because the metal you need is hostage to decisions being made for another product entirely. That changes the meaning of a price signal. In oil, a sustained price spike can bring drilling activity. In many agricultural markets, acreage can shift within a season. In silver, a higher price often just reveals that the market wants ounces that the current mine mix cannot quickly liberate. The silver is physically associated with other metals, operationally subordinated to other metals, and financially justified by other metals, so the phrase "the market will respond" becomes dangerously vague. Which market? The silver market may be desperate for supply, but the copper market may be weakening. Zinc producers may be retrenching. Financing conditions may be tighter than the silver chart suggests, and if the host metals do not support expansion, then silver remains trapped underground. Not because it is uneconomic to own, but because it is uneconomic to chase on its own terms. That is the byproduct trap in its purest form. Silver is not merely scarce. It is structurally prevented from responding like a free metal. Even if the industry suddenly accepted the problem today, the physical response would arrive far too late. This is the part casual commodity analysis usually skips. People speak about new mines as if they were factories that can be switched on after a board meeting. They are not. A new primary silver mine is often the end result of a bureaucratic, geological, political, and financial marathon that can consume most of a decade before a single meaningful ounce reaches the market. First comes discovery, which is the romantic phase people overestimate. A promising drill result is not a mine. It is only the beginning of years of proving continuity, grades, metallurgy, recoveries, access, and economics. Then come feasibility studies, then permitting, then environmental review, then local opposition, water disputes, land access questions, tax negotiations, infrastructure planning, power agreements, and financing. Then construction begins. Only after all of that does the market get to ask whether the plant will operate as designed, whether recoveries match the model, whether labor is stable, whether diesel arrives on time, whether the local grid holds, and whether the ore body behaves the way the spreadsheets promised. That is why the timeline matters so much. 7 to 10 years is not a delay at the margin. It is a strategic disconnect between present scarcity and future relief. By the time a new primary silver mine comes online, the conditions that justified it may have changed completely. A government may have changed the royalty regime. Capex may have doubled. Local communities may have hardened their opposition. Currency moves may have altered costs. And if financing conditions tighten in the middle of the build, the project can stall half-finished, leaving investors with sunk capital and the market with no metal. This is what makes silver different from the stories told during price spikes. The chart may move in months. Supply responds in years, sometimes in a decade, sometimes never. And remember, this slow pipeline would be difficult enough if most silver came from primary silver projects, but it does not. So the market is hit from both sides. Existing supply is trapped inside the economics of other metals, and new standalone supply requires a long lead time that is completely incompatible with sudden industrial demand shocks. That means the shortage, once visible, cannot be repaired at market speed. It can only be endured. And in real markets, endurance does not look elegant. It looks like delayed shipments, shrinking inventories, manufacturers paying up to protect production schedules, and investors slowly realizing that the phrase incentive price means very little if the incentive arrives years after the need. In silver, time itself becomes part of the shortage. Now put yourself in the position of the buyer, not the investor watching a price chart. The manufacturer with contracts to fulfill, payroll to meet, and production lines that cannot simply pause because silver became expensive. This is where the shortage stops being theoretical. For many industrial users, silver is not an optional input. It is purchased because its conductivity, reliability, reflectivity, and thermal performance solve problems that cheaper materials often solve less well, less efficiently, or not at all. And in sectors built around razor-thin scheduling, qualification standards, and massive capital commitments, use less silver is not a decision made over lunch. It can take redesign, testing, certification, supplier changes, and production risk that many firms cannot absorb in the middle of an operating cycle. That is why inelastic demand matters more than headline demand. A solar manufacturer does not shut down a production line because silver costs more this quarter. An electronics producer does not casually re-engineer contacts and conductive pastes across an entire product stack because the metal spiked. Grid equipment makers, automotive system suppliers, and battery-linked component manufacturers are not trading silver as a view. They are securing silver so a finished product can leave the factory. They may reduce loadings over time. Engineers always try. But gradual thrift is not the same as instant substitution. And then comes the next layer, AI infrastructure. The public story around AI is dominated by chips, models, and data. The physical story is power density, heat, switching, transmission, redundancy, and non-stop uptime. High-performance data centers are not abstract software castles. They are electrical organisms. They require transformers, switchgear, power distribution systems, connectors, control assemblies, thermal interfaces, and precision electronics. Across that wider hardware ecosystem, silver's role becomes less speculative and more systemic. The point is not that every ounce of new silver demand comes directly from AI servers. The point is that AI expansion intensifies the build-out of energy-hungry, power-sensitive infrastructure that depends on highly reliable electrical materials across multiple layers of the system. Once that build cycle begins, procurement teams do not ask whether silver feels expensive. They ask whether it is available. That is the demand-side trap. Supply is sluggish because silver is a byproduct. New mines arrive too late because development takes years. And demand, in the sectors that matter most, does not politely retreat when price rises. It absorbs the hit and passes it through, which means the market is not balancing in the old way. It is moving toward a harsher regime, where price no longer discovers equilibrium so much as identifies who is strong enough to secure metal and who is forced to operate without it. Even when silver exists, that does not mean the market can use it in the form it needs, where it needs it, on the timetable it needs it. This is where people confuse inventory with availability. A large institutional bar sitting in the wrong vault, under the wrong specification, or on the wrong continent is not the same thing as deliverable metal for an industrial buyer facing a production deadline. The silver market has always carried this hidden fragility. Ounces are not fully interchangeable once you factor in bar format, exchange rules, refining schedules, transport, insurance, customs, and the simple fact that global conversion capacity is finite. That is the refining bottleneck. A 1,000-ounce COMEX-style bar may exist, but if the immediate pull is for kilobars into Asian channels, the metal does not teleport from one form to another. It must be shipped, queued, melted, recast, assayed, certified, and redistributed. And when many participants try to do that at once, the bottleneck stops being theoretical. Lead times stretch. Premiums separate from headline prices. The chart says one thing. The physical market says another. This is why logistical friction matters so much in a tight market. It does not take absolute global exhaustion to create local scarcity. It only takes enough metal being in the wrong form, in the wrong place, under the wrong timing assumptions. Now combine that with a byproduct-dominated supply base and inelastic industrial demand. You no longer have a market that clears smoothly through price discovery. You have a market where visible benchmark prices can lag the reality of physical stress, because the benchmark reflects financial convention, while the real economy is fighting over conversion capacity, delivery windows, and immediately usable metal. That is when the price disconnect begins. The quoted price still carries authority, but less and less explanatory power, because the real question is no longer what is silver worth on paper. It becomes, what is the premium for silver that can actually be delivered, converted, and consumed before the production line stops? This is where the old pricing model breaks. For years, people have treated silver as a hybrid story. Part monetary metal, part industrial input, part speculative vehicle. But once you follow the forensic chain all the way through, a harder picture emerges. The decisive variable is not mood. It is not chart sentiment. It is not even the headline spot price by itself. It is the collision between depletion, captive supply, long project lead times, refining friction, and baseline industrial consumption that cannot fall fast enough. That is the framework that matters. If the world consumes a large baseline of silver every year in applications that are economically sticky, while most new supply remains tied to copper, zinc, and lead decisions, then price is no longer just a signal. It becomes a stress readout, a measure of how much pressure is building inside a system that cannot respond at the same speed as demand. So the investment protocol has to change. Do not start with sentiment. Start with dependency. Ask how much annual demand is essential rather than discretionary. Ask how much supply is genuinely responsive to silver's own price. Ask how long replacement ounces take to arrive. Ask where refining and format bottlenecks can turn nominal inventory into unusable inventory. And ask what happens when industrial buyers stop caring about value and begin caring only about continuity. That is when silver stops looking like a trade and starts looking like strategic material. The caveat is simple. No market moves in a straight line. Paper pricing can suppress signals for long periods, and cyclical slowdowns can temporarily relieve pressure. But the structural record is still there. Either you view silver as a volatile sentiment asset and remain trapped in the old model, or you view it as a constrained industrial lifeline and understand why shortages do not end when price rises.